to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. Chatting with me today is Paul Galloway, Senior Advisor at Strategic Treasurer. Paul, always a pleasure. Welcome back to the show.
Thanks for having me back again, Jason.
Our last episode was around common stock, and it was kind of the continuance of what we started at the end of 2022 around stocks in general. And I kind of want to end this segment on this last piece here to touch in around preferred stock. So let's go right into it, Paul. Can you kind of walk me and the audience through around what exactly is preferred stock?
Yeah, preferred stock is a funding vehicle or instrument that behaves like something that has characteristics of common stock and debt. Think of it this way. It's like a bond. You issue shares like stock, but there is a cash component to it that is typically it's fixed. Say, let's just throw out a number, say 5%. You issue these shares that have a face value of, I don't know, a lot of times you'll see them, one share is equal to $25,000 par. Meaning you hold one share or one unit, it's worth $25,000 for one unit. You know, you get 100 units, $2.5 million, so on and so on, right? But for each one of these units, they will pay a dividend on there. So like common stock, it pays a dividend, except with common stock, the board makes decisions around approving what that common stock yield or payment should be, right? So that dividend, it gets announced, hey, for the next 12 months, we're going to pay X percent dividend. It's typically cents, X cents for every share. So let's say 50 cents a share is the dividend on common stock. And in the case of a preferred instrument, it is a percent on the dollar value. And so let's say it's 5%. So if you own $1 million par of this preferred stock, you would get paid 5% on that $1 million.
Interesting. You say when the board already sets, kind of what that dividend payout is going to look like versus what's in that preferred piece of it. So there's definitely some intriguing interest, I imagine, in both pieces from a common and preferred. But why would a company want to issue this preferred stock?
Yeah, there's a couple reasons why. One, they don't want to do a follow-on equity offering, and so they don't want to issue equity. But in the same token, they may not want to issue debt as well because the makeup of their portfolio, the way instruments are treated and looking at their overall capital, it makes more sense to diversify it through a preferred stock offering where they can control the parameters a little bit better and maybe get more favorable terms in terms of the duration of the preferred stock. Sometimes preferred stocks can be perpetual. And so you borrow, $100 million and you have preferred stock that's really long dated or perpetual in nature, and you're just clipping a coupon every year, or every quarter or semi-annual payment that you're making to the investor that holds the preferred stock. And investors like that because they always know, hey, I'm going to get my 5% at these times throughout the year. And so it can be attractive for both the issuer and the investor.
So I know that we talked about the key difference was between how the board sets a dividend payout to the valuation of the value of the stock. But what other things or what other differentials between those two?
That's a great question. We did talk about some of the differences already, and around the dividend, it's definitely different. Common stock, it's paid out in cents. It's approved by the board. Preferred dividend is a percent of par value. It's set in the agreement at issuance of the preferred stock. And so the parameters are set in stone. They don't need to be approved again by the board. There may have to be an approval to issue the preferred stock by the board, but there doesn't have to be an approval on the dividend. The other thing is that the cost of capital is different. So cost of capital for common stock is the highest rate that you pay. When it comes to preferred, being a kind of a combination of common and debt, it turns out that preferred ends up being a lot less costly than common stock.
So with preferred stock, how is it treated from a credit perspective?
When you think about how rating agencies look at ratings and they look at the overall balance sheet. They hit, when I say hit, they'll treat, let's say you're a regulated company like an insurance company. They'll treat it a certain way based on its component, not its place on the balance sheet and the mix in totality. So what it will be is common stock will get hit with a certain percentage, and then preferred stock will get hit with a certain percentage, and debt will get hit with a certain percentage. And you think about it, Terry, the highest hit, I'm just saying hit, or highest percent of the component makeup of the risk, let's say RBC ratio in this case, for regulated entities, that RBC ratio takes a bigger hit for common stock versus preferred versus debt. So preferred's kind of in between because it's kind of a mixture of the two. If you have a diversified balance sheet, they end up giving you credit for that. Even though debt is a lower hit towards your risk-based capital. And what I mean by that is that with the equity, it can raise your RBC ratio, how much capital you're required to hold. But because you have a more diversified portfolio, you can diversify away a chunk of, in some instances, all of that RBC ratio lift because you hold common stock. And so same thing from, let's say, a non-regulated entity. It's similar in nature. What the rating agencies are going to do is they're going to look at your overall balance sheet, and they're going to say, oh, you have components of common stock, preferred stock, senior debt, the revolvers, contingent liquidity, these other factors. And all of these get a certain allocation between debt and equity. What they do is they look at that debt to equity ratio. With the preferred stock, that helps you with the debt to equity ratio when you issue, because it is, kind of a hybrid issuance. It has a common stock component, it has a debt component, so it doesn't hurt you as much as common stock would in terms of your equity percentage allocation necessarily, or your debt percentage allocation. It's kind of a mixture of both, so it smooths it out. And so if you're required to have a certain percent of equity, let's say it's 25% and then 75% debt, and you can't change that mix. I'm just making up numbers here. You don't want to grow the debt piece, because if you grow the debt piece, you might get a ratings downgrade. And you want to somehow, maybe you want to raise the equity side because you are really close to that threshold and tripping it. Well, preferred stock can kind of help balance that out and allow you to raise capital without doing a follow-on equity offering.
Well, Paul, as always, great information, especially around preferred stock. Really appreciate the topic for today, and really giving myself a good education, hopefully some listeners out there as well. So thank you again, Paul, for joining me today. For our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasurer.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.